Thank you so much for coming today. We're going to go ahead and get started. Today's panel is an economic outlook from the Federal Reserve Bank of Atlanta. We wanted to just briefly go over some of the upcoming events in the CFA Society of Atlanta. We have our second annual Ethics Challenge on October 14th from 1 to 5 p.m. We also have, I'm just going to lose the mic. We also have our online series for stock markets and crises, Insights from the Pentagon on October 19th from 12 to 1. Additionally, we have a online series for executive job search, planning and organizing your campaign on October 21st. And then really exciting panel from Phil Moran. We have Introduction to DeFi on October 26th from 12 to 1. But today's panel, I'm going to introduce Brent Meyer. Brent Meyer is an Assistant Vice President and economist in the Research Department at the Federal Reserve Bank of Atlanta. He leads and sets the strategic direction for the Economic Survey Research Center, provides leadership for monetary policy advising process, and serves as a member of the Research Division's leadership team. His primary research interests include firm behavior, survey methods, inflation, inflation expectation, macroeconomics, and monetary policy. Brent, pleasure to have you today. Thank you so much.
Don't clap yet. I don't want to use that mic. Can you guys all hear me?
Yeah.
In the back, we're good? Excellent.
Can't see you.
Oh no, I kind of...
We need some light up here.
You don't need to see me. No one wants to see me. I usually stay in my cave. So yeah, it's nice having a little background music while I do this. That's a new one for me. So before I get started, what you're about to see are my views and mine alone. They don't necessarily reflect the Federal Reserve Bank of Atlanta's views or the views of the Federal Reserve System. If I wasn't on camera, I'd say they probably should. So let's start here. Let's start with a kind of just a quick overview. And camera guy, I'm going to make you work today. I like to move around a bit. Basically, the situation we're in right now is a mismatch between aggregate supply and aggregate demand. Demand's up here, supply's been constrained. We need to work to get those two things in line. Reflecting very strong demand amidst constrained supply, labor markets are very tight. And we see this in a variety of metrics, tighter than what we had seen over the last 3 business cycle peaks, in fact. And in the midst of all this, all these constraints, surplus of demand. It's perhaps no surprise now, maybe at the beginning of the pandemic, but no surprise now that inflation is very elevated. I want to talk about the prospects for inflation going forward. One of the things that we see coming out of my shop, and I do a lot of business surveys, both nationally and in the district, are that firms are continuing to say that input costs are extremely high, they're still constrained, and they don't really expect a whole lot of relief coming anytime soon. Alongside this mismatch of supply and demand, very high inflation, the Federal Open Market Committee, the FOMC, has been working to try to bring inflation back in line with its price stability goals. And currently, the Fed funds rate is in a range between 3 and 3.25%. We'll talk a little bit about maybe where that might head. And as always, and over the last 2.5 years, things remain highly uncertain. So don't be surprised if my forecast is worse than the weatherman's here. All right, so here's the crux of the problem. This is a picture between looking at the labor supply, this blue line, and labor demand, the black line. When it's green, that means there's a surplus of supply relative to demand for labor. And you can see right now we're seeing a very large mismatch. Now I could show you this in a variety of different metrics on the real side of the economy, but I think this sums up the picture of kind of where we're at right now. Alongside, and I'm sorry, may need to squint in the back, but basically this is coming out of one of our quarterly survey, this CFO survey that we run with the Richmond Fed and Duke University. And we just ask firms every quarter, what's the most pressing concern on your mind? What are your most pressing concerns? Over the last couple of quarters, it's been cost pressures and inflation, labor quality and availability, supply chain concerns, demand. Monetary policy here is kind of interesting. About a year ago, this wasn't even on the map for most CFOs. Now it's risen into the top 5 or 6 concerns. As a backdrop to the strong demand we're seeing, this is a look at real personal consumption expenditures. This is household spending. I don't want to get in the way of this topic. I thought you had a question. By the way, feel free to, if you guys want to talk about anything in depth or talk about anything else at all, this is your time, so feel free to interrupt me and we can go off script. But this is looking at consumer spending, inflation-adjusted consumer spending. It was broken out by its broad categories and it's benchmarked to the beginning of the pandemic. And what you can see, and this is still the case, that durable goods spending has been relatively strong. Now we're starting to see this rotation back, and it made a ton of sense, when everybody was shut up in their homes, that they're outfitting their house with gyms at home, the Peloton, the pandemic puppy, we did all that stuff too. There's only so many Pelotons you can buy before you're done, right? And I see we're starting to get back to that point where last year we were all virtual for this conversation. Now we're back in person, we're engaging in experiential spending. So we're starting to see services climb a bit, and it's right back to sort of where it was pre-pandemic in level terms. Unfortunately, in recent months, most of the consumers are still spending, money's still flying out of their wallets, but it's increasingly going towards paying that increased price. So this is a picture between nominal and real spending, and this nominal part is all these orange bars. So you can see nominal spending's holding up, money's still flying out of the wallets of consumers, but they're not getting a whole hell of a lot of return. And just to set the backdrop, and I mentioned this at the outset, the labor market is tight. I've heard there's some folks that'll quibble about how tight it is. I'm going to argue it's as tight as tighter than it has been over the last previous business cycle peaks. And that does not mean that I'm up here saying that we're at a peak. I don't think we are, and we'll have that conversation here in a bit. But this is looking at quits rates, hiring rates, job openings, and wage growth relative to the past peaks in December of 2007 and in February of 2000. Yes?
Now, we know the pandemic hit everybody equally, so have you looked at this blue collar versus white collar, or try to break it down a little bit more?
Yeah, absolutely. So did everybody hear that question? It was just, there's been a lot of dispersion during the pandemic, and are we looking across the industry and across the income spectrum? And the answer is yes. And you're absolutely right. At the beginning of the pandemic, smaller firms got hit harder. Service positions, in-person service positions, non-essential workers got decimated. Those folks, so if we're just talking about wages and employment growth, at the low end in the experience, in the in-person services jobs, their wage growth has outpaced wage growth across the income spectrum. Doesn't mean that their level of wages are higher. That's certainly not the case. But their wage growth has increased markedly, and we are seeing a lot of strength especially in that retail space and in that services providing space. A lot of strong growth there. But even if I cut this across industries and look at employment growth more generally, there's still a strong employment growth is still strong across the entire private economy. I saw another question over here. Oh, that was your question? That was a great question. So again, it still looks like broad-based strength to me. Okay, and let me tell you something that everyone knows, because you can feel it. It's visceral. It's something that I think in 2020 probably didn't think was likely. In fact, if you were to run sort of a baseline standard macro models that we would run, the probability that headline CPI or PCE inflation would be above 3% 2 years out would have been de minimis, would have been less than 1%. Now, I showed you this slide last year. You guys remember this? This little transitory talk? So even though our macro models were wrong, epically wrong, businesses were telling us the right story. Okay? Firms last year, and leading up to the end of the year, leading up to when we really saw inflation broaden out, become very high, firms were saying, hey, this little transitory thing that you guys are saying, that ain't what I'm seeing. And I don't anticipate these unusual cost pressures to alleviate anytime soon. Not only that, along with these cost pressures is a tremendous amount of constraints on our ability to meet demand. That's not improving anytime in the near future. So I thought I'd give you an update on this, because I think the story is more or less the same. So inflation remains very elevated. Tell you something you don't know. Here's kind of something we're watching, and here's something that's, I think, likely to play out in tomorrow's CPI report. We're continuing alongside this rotation away from goods purchases towards services. We're seeing price pressures, relative price pressures between goods and services start to flip. Okay, so we're seeing some alleviation in price growth in core goods, and core goods just excludes food and energy goods. But we're not seeing any alleviation here in core services. Okay, so that's largely, that has a much closer tie to what's happening with wage growth and shortfalls in labor supply on the service side. That's sort of wonky econ term. That's what we call like sticky. This is something that sticks around. It's durable. It's persistent. Okay, it's the opposite of transitory. And core services is a much larger component of the overall CPI than core goods. Okay, and even here with core goods, while we're seeing prices fall or decline, price growth slow a bit here, we're still not seeing anywhere near the typical pattern in the pre-pandemic. So we haven't really made a whole lot of progress here, and services have continued to ratchet up. Now here's a much noisier, different way to cut the CPI, but I think the story that comes out of here is one that's important, and is important for monetary policymakers in particular. So apologies for how noisy this is in the background. If we just look at the blue line here, okay? The blue line says 74% as of August of 2022. That is the share of the consumer price index weighted by expenditure weight, but that's the share of the CPI rising at rates greater than 5%. Okay? 3/4 of the basket of the consumer's market basket is increasing at rates greater than 5%. Last time that happened, 1980. Okay. And that comment was, I remember that. Yes?
Can you speak a little to how that basket has changed since the 80s? I've read about that a bit. That it's, what makes up CPI today has changed quite a bit from the 70s to 80s.
Sure.
Maybe not components, but weightings within those.
Yeah, so that's a loaded question for me, and we only have like 40 minutes or so. So I've spent my entire career digging through the detailed price data and the methodology. So I could talk ad nauseum about what's going on there. Some of the broad shifts, much more goods based. Okay, so the share of goods in the CPI was more like a 50-50 split back then. Now it's much more service based. Okay, when you're thinking about monetary policy and how it impacts the economy, that's actually something that we need to keep a close eye on, because there's a much more tenuous link between the impact of monetary policy on the economy, on the service side of the economy. Services tend to be much less cyclical than goods production, right, and goods prices. So that's something to keep our eye on there. Carson, can I just leave it like that? Is that good enough? Because I could go into like the hedonic measurement and all that. These people don't want to hear that. All right, but yes. Can I start here? I'll come to you, please.
So a third of CPI is only 1%.
Oh yeah.
And it's notoriously lagging relative to housing prices.
Yes.
So how can you comment on that?
Sure.
It seems like that the CPI measure is very high, but it's really, as far as consumer experience is concerned, it seems to be really lagging.
That's a very, very good point. And I don't know if we all heard that, but the comment was about how the Consumer Price Index measures housing services, okay? And the way that it measures housing services is not based on the purchase price of a house or even the mortgage payment, right, that homeowners are paying. What they're attempting to measure there is something called owner's equivalent rent, all right? And now I'm going to get into the weeds, and well, you can all blame, I'm sorry. I'm sorry, we're going to all blame you. So the comment was owner's equivalent rent is about a third of the CPI, and it's a little bit less, but it's still huge. It's 1/4. All right, if you add in the rents, the pure market-based rents, you get up to about 1/3. But if we just focus on that owner's equivalent rent component, the way that that's measured, so the size of that component, the data comes from the consumer expenditure surveys, and there's a question on this consumer expenditure survey that asks households, hey, if you put your house on the market right now, what would you rent it out at? Okay? That may or may not be their mortgage payment. It may be a surplus of their mortgage payment. These folks may not have a mortgage, they may have no clue. But they just put in whatever that is, and then that is that share of expenditures that is reflected here. That's that 1/4 of the overall CPI. That's how that's calculated. And then on the price side, what the BLS does, and I'm on camera, so I got to be a little careful. I don't think what the BLS is doing is necessarily wrong. It just, like you said, it lags market rents. And the way that they're doing this is they have a sample that they've broken out in what they do is they sample nearby rentals and use that for the approximation for what homes in the area that are owned, what those price increases would, what that rent increase would be. And they break that sample out into 6 different subsamples, and they service that, and they sample that service. They actually check prices on that panel twice a year. So basically what we're getting out of owner's equivalent rent is the 6th root of a 6-month growth rate, right? That by construction makes it really slow moving, okay? And if you look at the market information, if you look at Zillow rents, if you look at all those other rents, they tend to predictably lead what's happening with owner's equivalent rent. So you're right, some of this is OER in recent. And as we go into about the middle of next year, I think we should anticipate, based on what's happening with those market-based rent index, some slowing in that component. But even if I was to, again, I slice and dice this stuff all the time. If I was to cut OER out of this calculation altogether, this picture looks remarkably similar. Okay, so that's not telling us, it's not, aha, housing's the problem. That doesn't really reflect what's going on with the most consumers, and that's what's biasing this picture. I don't think that's not the story at all. And in fact, I like cutting the CPI like this because it removes a tendency that all economists and economic analysts and market watchers tend to have. Well, I can explain away that. I can explain away that price increase. Oh, that used cars, I can explain away that. That has nothing to do with inflation, that's just relative price change. Okay? I think, back here in early 2021, where things were starting to broaden out, a lot of people were telling those stories. Okay, they're fundamentally missing the connection of monetary policy to inflation. So what we had at the beginning of 2021, or in late 2020, beginning of 2021, were an outsized influence of a small set of prices that were directly linked to pandemic impacts. Okay, and then when the majority of older individuals got vaccinated at the beginning of 2021, they started going out and trying to engage in spending, and you saw at least car rental prices spike. You saw lodging away from home airfares, the level of airfares bounce back pretty precipitously. Those were all relative price changes, and those were all when you're sitting around the table talking to policymakers, you can tell a very clear story of a connection between a one-off change in a market and that price change. As we move throughout the year, and as we're sitting here right now, it's incredibly broad-based, and that story, those stories don't hold water anymore. And I think a lot of people lost the forest by focusing on the trees during that time period. That's a good question. Yes?
So, Brent, I guess my question is, given the changes in the service, inflation, labor markets, commodities, is the monetary policy of raising fund rate, does it need to change because obviously the inflation drivers are now changing and they're more sticky? Are we seeing a difference impact of the Fed fund rate hiking?
So I was going to close with that. Can
okay.
I come back to that? If I don't answer your question to your satisfaction, let me know. Okay. Yes.
Do you think our data collection methods? We talk about household surveys, and I know unemployment rates, some of those survey. We're sort of assuming that people don't pick up their phone, don't answer their mail. I assume that we sent the BLS employees home in March 2020.
Yes.
And they were told we're in a pandemic. So inflation's not going to go up, so just plug in your model that milks up like 1%, because that's what it was before. We're not going to make you go to the store and check that stuff. So, with surveys and phones and mail and sending people home for 2 years, I think most federal employees went home for 2 years. I know State Department folks were working at home. So it seems like we've read a lot of this data, but it just doesn't feel like it's our data collection methods are getting better. I'm assuming we're going to go to the banks and say, hey, can we pipe into Bank of America, JP Morgan, Citigroup, and just hit Joe Consumer, and let me measure the level of this bank account rather than just taking these aggregate balances, which may not be good for civil liberties, but it seems like we're really poor on the, I don't know if anyone's going to admit that, but on the data collection, it seems like we're getting really, I don't know if a lot of noise in the data. I know you can measure aggregates with bank accounts and things like that, but it seems like at the individual level, we're getting some bad data.
Can I make you feel a little bit better?
Yes.
Let me attempt. So the question here, if you didn't hear it, was, basically the CPI and the BLS's methods for collecting prices changed pretty sharply during the pandemic. Okay, that's true. Phone surveys went up. Online surveys actually came into. They started leaning much more heavily on online, like web scraping and things like this, and online surveys of prices in the grocery store and things that they weren't doing as much prior to the pandemic. But that's okay. That's good news, because we have there are separate data sources, not unlike what you were talking about, and where we can actually track spending. With individual spending using some of these private data sources. But there's a tool out there in the public. It's called the Billion Prices Project, and what it does is it scrapes all the millions and millions of prices in just about every large country in the world. And in the U.S., it captures a lot of these price movements, especially in goods and in goods prices in particular. They do a fantastic job, and in services outside of rents, again, I think they do a fantastic job. That correlation, or that movement between what was going on in the BLS data prior and the CPI data prior to the pandemic and current is unchanged. There's been no degradation, at least picking up by sort of statistical method. We can't pinpoint any sort of degradation in the quality of the CPI data relative to what it was pre-pandemic when you use this Billion Prices project as a benchmark. A little bit better? Let's go.
Yeah, somebody went in there and smoothed the data, so yeah.
I don't believe that.
Yeah.
I don't believe it. Okay, so relief, and this is a bad joke. If you know anybody who's a college athlete, or if you've ever taken a shower in, you know, in a gym locker room, you know that having Gold Bond is fantastic for athlete's foot and things like that. So is there any relief on the horizon? Well, how would we get relief? We have this mismatch. Well, we could see an increase in supply. We could see an easing of supply chain constraints. That would help. We could see a return of individuals who left during the pandemic. That would be helpful. We could see an increase, a market step up in capital investment and automation that would replace the need for some of these lost workers. And on demand side, well, we might be able to see some waning support on the fiscal side for households. Increase in prices definitely takes a bite out of the ability of consumers to consume, and I showed that picture earlier. And then lastly, the rising interest rate. Yes?
Comment on, maybe you're going to on the next bullet, but
sure.
The Great Resignation, you have actually dueling articles from equally credentialed people who say that, no, it's not a thing, and others will say, yes, it is a thing. So labor force participation looks like it's down, but then some people sort of explain that away. What's your view on that?
I'm going to talk about that here very shortly, as long as you don't make me talk about quiet quitting and things like that. I don't want to do that. Yes?
On the supply side, does the data have any suggestion there's some kind of intentional withholding supply because corporate America can get away with it right now? Because
no, I mean that works that works directly against the profit motive for a lot of profit maximizing firms. They're constrained in their ability to meet supply or meet demand right now. If they were able to bring more supply online, especially if they were able to do it faster than their competitors, they're going to win.
Or maybe let me flip the question: is there any quote unquote intentional or hidden price gouging?
You guys ought to get together.
I'm only conspiracy with the government.
It seems like you hide it right now.
I have no evidence of any sort of hidden price gouging. I think that a lot of what we've seen is a completely rational response to the mismatch between supply and demand. You get these stories. You want to cut that camera from that? You get these stories after every hurricane, right? Okay.
You want price gouging. Otherwise, you're going to allocate someone who has most free time to stand in line. I'd rather allocate on who has money. I'm assuming people.
I was with
money.
you there for a little bit. The pricing mechanism works.
Right.
Okay, and we'll leave it there. Okay, so price supply constraints. Again, I'm going to lean on the CFO survey here. Are you seeing a larger increase than normal in your costs? And this is yes in the majority of my costs, and these are the halfway through 2021, right when this was starting to blow up. At the fourth quarter of 2021, when everybody kind of recognized that this was not transitory, and here currently. So there's a lot of this additional price pressure due to supply constraints. How long do you anticipate it continuing? Hey, guess what? Looks pretty persistent. This bucket is more than a year for those in the back. Equally concerning, to me at least, as somebody who digs through these data too. The share of those that are becoming more uncertain is increasing. It sort of made sense at the beginning to be pretty uncertain, but now we've been dealing with this for quite some time, and individuals and firms are adjusting to this. And they're saying, they're starting to throw their hands up a little bit more and say, I don't know, I got no clue. That's a problem. Why is that a problem? Well, again, I already purported that firms were profit maximizing, and there was this mismatch between supply and demand. Well, what would a typical firm do in this, especially a typical mid-sized to larger firm do in this environment? Well, they're going to go, all right, so this supplier can't give me anything that I need. I need to go over here. I need to diversify my supply chains. I need to onshore or nearshore my supply chain, so I'm much more resilient to this crap ever happening again. Okay? What's that likely to do to prices? Increase. It's likely to keep sustained upward pressure. Unless firms just really want to take everything in margin, and I don't think in this environment that's what's going on. So we have this sort of structural shift in supply chains, and I'm going to use buzzwords here, from just in time to just in case. You've heard this too, right? I think this is happening, and I think this is one piece of evidence that suggests that these things are likely to continue for some time. Now, whether or not when we're clear of this and we're 5 years, with the pandemic is 5 years in the horizon or in the rearview mirror, and people go, okay, this is way too costly, I got to switch back to what I was doing previously and go back to just, I have no idea. But I know that there have been investments, and they're probably, given some of the comments already, this is probably not, there have been investments in things like bringing the semiconductor and microchip plants to the US, right? Those are pretty durable investments. It's going to take years for them to to come online, and no one's going to want to see those things fail immediately. So I think you're seeing some of this shift. Again, I think it's moving towards a higher cost of production. Here's another point that we can glean from these surveys. If you look at the difference between goods producers and service providers, many more service providers are seeing these costs persist for quite some time. That's okay, obviously due to labor, but that's kind of interesting too. Again, when I was showing you those inflation pictures, the goods prices are declining, service prices are continuing to ratchet up. I think this is, again, further suggestive evidence that this trend is going to continue for some time. I'm going to skip this for time because you guys have better questions, and this is just looking at pass-through, and there's diversity of pass-through. Let me get to your question here. So the argument is on this picture, actually. Okay? So this is looking at labor force participation rates by age. The green line is 25 to 54, the orange line is 16 to 24-year-olds, and this blue line is the 55 plus. Okay, so here's your argument. At the onset of the pandemic, the cohort that was in this 55 plus category, they left, okay? They left, and there's very little indication that that cohort is attempting to come back like it would have during the like it did during the Great Recession, and it didn't space, right? And that leaves that in aggregate, this labor force participation rate, just looking at the share of the overall individuals age 55 and over, this suggests that that they're really not coming back. That there's this persistent gap relative to their participation rates at the beginning of the pandemic. But, just one second. Sure. That's like a half answer to your question. There are cohort effects, and then when you look at labor force flows, so moving from not in the labor force to in the labor force, you're seeing a more return to normal in those flow rates. Okay, that's not necessarily a bad thing, but that's not going to fix this. Okay, and then there's another thing, and I'm going to get in the weeds, and I'm sorry to everyone. You can just blame this table, right, for a lot of this stuff. If I was to plot labor force participation rates going back to, say, the 1980s, well, actually, if we go all the way back to the 50s, we'd see this huge upswing in labor force participation rates from the 50s to about 1980, 85. A lot of that was the introduction of women into the labor force at much greater rates than
Paid labor force.
Yes. Outside of home production. Thank you. You were going to have to delete this thing. All right, and then what we saw coming about 1985, forward, and some of this was baby boomers too, entering the labor force en masse in the late 70s and 80s. And what we're seeing now is a lot of that secular decline in labor force participation rates. Some of this is coming from the young end, the delayed initial entry into the labor force on the part of younger people. They're typically out doing other things, engaged in things that make their college applications and essays look a hell of a lot better than I just worked at Publix, which my daughter does work at Publix. She's 16. And there's some of that, and then the other thing that's been happening and will continue to happen is that that rat moving through the snake, and I'm sorry, the large baby boom population is starting to exit the labor force. And so some of this, we're never really, I don't think we're ever going to get back to the, well, over the next 15, 20 years, we won't get back to the labor force participation rates we saw in February of 2020. It's going to continue. There is a gravitational downward pull just due to the demographics issue that is going to arrest that ability for labor force participation rates to increase, unless we took away everything that Grandma and Grandpa had, right? And they didn't have a choice. But again, I don't see that happening. There was another question. Yes.
So just to give you a sense of my experience. For our first home, our mortgage rate in Georgia was 10% plus points. My children have, low single-digit mortgage rates, but I don't forecast that that's going to be the case for my grandchildren. One of the things that bothers me about this chart is that the people who know how to handle inflation have left the workforce. The workforce is full of people who don't understand rising prices.
Yeah, so we're doomed to repeat a lot of mistakes and a lot of learning that went on in the 70s and 80s.
Plus, there's kind of a comparable kind of guns and butter kind of scenario.
Oh, sure.
From fiscal spending as well. So that's just kind of like my concern, that I'd like to see more older people go back, even on a part-time basis, just to.
Yeah, especially, when in a lot of these price setting mechanisms on the side of firms, like here's how we used to deal with that.
Right.
Because, and you're right, and she makes a very valid point. The majority of individuals that are of adult population at the moment right now weren't alive in the 80s, 70s, and 80s to actually experience. Or if they were babies. We have no context for this environment outside of learning from history, which again we're foreshadowing where I wanted to conclude. Okay, these are great questions. Yes.
So a lot of this makes me think of volatility, like looking at volatility in your numbers. Have you all done any analysis looking at the vol of your numbers now versus the vol of your numbers in past times? Because that's going to be an indicator for us as investors, like, or at least for my firm, how I'm going to trust these.
Oh. So you're talking about our root mean squared errors, our forecasting performance?
Right. Well, and like you're getting all these samples, so you're calling people like whatever. Are you starting to see bands just getting bigger and bigger of what, you know what I'm saying?
No, this is so there's really, I think there's two questions in here. Let me answer what the last point you made. We actually have a national measure of a survey of business uncertainty, where we actually ask CFOs and C-suite folks to project in a probabilistic way sales growth and employment over the year ahead. We can aggregate that up, and we have measures of aggregate uncertainty for the non-farm business sector, part of the economy. And what you see is a lot of uncertainty. And we was talking about this at the beginning with the disparate impacts COVID has had. So realized sales growth and employment rates, that dispersion widened out immensely at the beginning of the pandemic and has stayed with us. So we're still in a world that's much, even on an own firm basis, there's much more uncertainty than there was pre-pandemic, and that's continuing to persist, even though, I mean, we're all here in person. The kind of pandemic's starting to become it became endemic, and everyone's a hell of a lot less scared now than they used to be. But that sort of dispersion is continuing, and then own firm uncertainty is continuing to be high. So in an uncertain environment, forecasting performance is almost by definition gonna be pretty poor. And then if you wanted to talk root mean squared errors, like I think all you need to do is go back and look at the forecast for what 2022, 2023, interest rates were going to be back in March of 2020, and I think you get the gist of where I'm going.
Yeah.
These are fantastic, by the way, much better than one. But, okay. How much time do we have? 15 minutes? So do I go all the way to 1, or do I stop short?
All the way. All the way.
Okay, you guys are having fun? This is fun?
Oh, yeah. We love this.
This is an interesting group. Okay, all right, so in this picture, I'm telling you that labor force participation rates are likely to be depressed relative to what they were in 2020. Okay, that has implications for available labor supply, obviously. And we see this reflected in our survey data as well. Is how difficult do you expect hiring conditions to be at the end of the year? And we asked this a couple of months ago. Harder than it is now, and there's a question I'm not showing you that already says this is way the hell more difficult than it ever used to be. And same with retention. So retaining employees is at least as hard, if not harder, than what it was on average, prior, 12 months ago. So this then becomes an interesting picture. This is wage growth, and I cut these off again just so we could actually see what was going on in here, because there was a huge spike at the beginning of the pandemic and a huge decline as individuals. In the way they calculate this, is just an average of everybody's level of wage, hourly wages, right? So when you lose the broad low income or low wage in-person services component of this, that's going to actually put a lot of upward pressure on wage growth. As they start to come back, you see that decline. So there's some composition effects in there that I'm kind of cutting out. But I want to focus here, because this is interesting to me. So I showed you a picture earlier. Inflation's running right around 7.5, depending on what measure you want to focus more closely on. Wage growth of average hourly earnings of production and non-supervisory workers, the broad swath of the labor force, is growing a little bit less than that. And we get forecasts, again, from our surveys that say, oh, I'm forecasting wage growth for my workers at about 5% for the next year out. In an environment where we've seen inflation outpace wage growth, and wages, again, they're sticky, so they're slow to adjust, but when they adjust over long periods of time, they tend to adjust one for one over, I'm talking decade spans. They tend to catch up. We're not seeing evidence of a significant catch-up at the moment. We saw a little bit here in 2021, and again, if I was to cut this, a lot of this is going to be the very strong wage growth for the low wage earners. But this is sort of a question mark for me. I've done some academic research on this, actually trying to dig in and see. So we all, I think most of us here are enjoying some form of hybrid work now, where you're working at home a couple of days per week, you're working at your in person a couple of days a week, maybe 3 days a week. And we're enjoying that increased flexibility. Well, there's evidence that employees, well, they really like that flexibility too. In fact, they're willing to pay for it. And many firms actually know that they're willing to pay for it. So they see this increased flexibility of where you do your work as another amenity of actually working at your firm. So there's some offset that may be happening here that actually is meaningful in like about a percentage point per year. So it actually looks like there's a meaningful offset here. But where we go from here in tight labor markets, I think, is a huge question. And here, this is just cutting out wage growth by private goods and services, and you can see the very strong services wage growth. So I've told you two things on the supply side. Supply constraints, don't see much evidence that those are going to lift in mass, and maybe if they do on the good side, maybe we get back to somewhat more of a imbalance, more imbalance on the good side. The service side, I still think there are a lot of these persistent sort of persistent and perhaps structural changes happening at the moment that are likely to leave a bit of upward pressure on inflation. There, capital investment. Okay, that doesn't look good. I'm going to skip over this. Yeah, I don't. You know, I typically don't have a lot of good stories to tell. I tend to be pretty pessimistic, so I'm sorry. Here's decreases in demand. All right, so what are we seeing? We're seeing waning support and waning savings from the federal programs, from the dramatic amount of stimulus that we saw during the pandemic. Okay, so in fact, let me skip this. Let me start here because I think it's an easy picture to see, and then I'll go back because that's a harder story to tell. This is the personal saving rate. Okay, this doesn't mean that this is actually a measure of what's going into household saving accounts. This is just an aggregate money left over that wasn't consumed after taxes. You can see the initial surge in stimulus here, and the subsequent two other programs kind of show up here. Okay, and we were running at about a saving rate on average of right around 15% for a while. That's begun to wane. Okay, so the current saving rate is below where it was pre-pandemic. Does that mean that we've run through all of the excess saving that occurred during the pandemic? No. This is a flow measure. This is not a stock measure. You'd have to take you guys are CFAs, right? You've got to take the integral here, right, to really look at that. And this is actually fantastic. I'll come back next year because you guys get this stuff. This is fun. Well, this is actually what this is doing right here. Okay, it's adding up all the excess saving, and this is actually starting to decline, and it's declining a bit faster than we thought a few months ago. Okay. And you can think about this in the context of that first picture between nominal and real spending that I showed you. Folks, and we've all read these stories. Like, I've been cooped up in my house for 2 years. I'm getting the hell out. I don't care how much that vacation costs, and it's going to be the best damn vacation I've taken in forever because I've been sitting on a bunch of cash. Or you're going to raise the price 20%? I don't care. I'm still going. Right? And that's largely the story here in the upper half of the income distribution. Okay, and a lot of these savings are actually sitting in household balance sheets at the upper end of the income distribution. And in fact, if we were to dice this and look at the top 10% and 1%, the majority, a ton of this is, the lion's share of this excess saving is sitting there. On the low end is a different story and a much sadder story, too sad for the lunch conversation. Yes?
So thinking about labor, unemployment, wage growth, hypothetically, your opinion, let's say wage growth stays sticky at 5, inflation's at 4. Is that a problem?
No. Okay. No, so the question is whether, if inflation actually comes down to 4 and wage growth is at 5, is that necessarily a problem? Is that something that's going to tick off a wage price spiral or something? No, I don't think so at all. I think I think we have some room to actually catch up on real wages. Okay, and I'll show you one more picture on that here in a minute. So I think we have a little bit of room, but I also think you have, and this, I'd be really interested in your thoughts here, but typically wages are not only tied to what's happening on the nominal side with inflation, but it's also tied to what's happening with real worker productivity. Okay, and productivity rates heading into the pandemic were low, about 1.5%. Our best guess is they're still right in that range right now. And I think there are competing forces. Oh God, I'm going to say it, the whole quiet quitting thing. I think there's some of that stuff going on, and I also think that there's some individuals that allowing an increase of flexibility. Well, maybe we haven't fully figured out this new recipe for the world we live in now, but I think for some individuals, this is unlocking or unleashing an additional productivity. At least on the service side, and we can see this in data from household surveys, you see individuals devoting more of their waking day to actual work. They're commuting less. They're actually, and this is somewhat alarming, they're spending less time on hygiene and getting actually ready to go out in public. All right, it's not shocking, but it's not so great. But they're actually using a chunk of that time to actually engage in work activities. Well, the way we measure productivity, that's actually going to show up on the service side in particular as increased productivity. So I think there are a couple of things, and we don't really have a solid idea of how this is going to play out, but at least on productivity growth is at least around 1%. Okay, trend productivity, not what happened last quarter in the NIPA account. So we're starting to work through. We're starting to see, coming back to support for demand. We're starting to see this wane, and on the low end of the income spectrum, we're starting to see, an increase in pain. And the question I pose to this group, and the question I pose to a lot of folks, is when we're thinking about where monetary policy is going, what's worse what's worse for low-income households? Is it high inflation or higher unemployment? I haven't done the
High inflation.
High inflation is my guess too. I haven't done the full general equilibrium model result to see what the welfare differences are. I think I can say that in this
Well,
one
it
too.
depends on what real wages are. Like you just said that.
No, that's right.
Yeah.
But
if your wages are growing faster than inflation, I'd much rather have a job than not.
Sure.
Yeah.
But and again, then you got to think about the individuals that are out of the labor force too. When you're dealing with high inflation, inflation is an implicit tax on all cash holdings. Okay. So on labor markets, what really needs to happen? I think I've told you labor supply is not likely to come back anytime soon. What we need to start seeing is actual employment growth, or some proxy for labor demand, like vacancy rates start to decline. You got to squint, but you can see a little bit of this starting to happen already. I think as we move through next year, I think we'll continue to see this decline a little bit, and that shouldn't necessarily be worrisome outright in and of itself. It's just more of a recognition that growth is likely to be soft going forward, or at least softer than trend. But even at, this is the 3-month average, this blue line, it's still 400,000 per month. It's still really, really strong. So slowing a little bit, but still at a high level. And going back to that gap I showed you at the beginning.
So is the vol on both of those going down? Is that true? That's what the picture's showing.
I think the month-to-month volatility on this is still pretty high.
Okay.
It's still. I think if you actually looked at true, like a variance or standard deviation, I think it'd still be pretty high.
Okay.
And the other metrics that we have, like the ADP payrolls that are supposed to sort of align with this, that ability to track what's happening in the BLS data is about as bad as it used to be.
Okay.
It's no different. It's no different. Like, I don't think they're making this number up either. So we have the increase in prices, and this is what we're just talking about with real wages being negative. Okay, and this is by just about any measure you want to cut this. This comes from an Atlanta Fed, our wage growth tracker, and this is actually tracking. I think it's a cleaner measure of overall wage growth because it's actually just looking at the median wage growth for individuals that are continuously employed over the last year. So I think that's a good measure, and that's negative, but any other measure that you plot would still be negative. So this gets to come to the conclusion. I'm sorry I'm late. I'll rush through this a little bit. The Federal Reserve, the FOMC, have started to recognize, or started to say publicly, that we got to fix the demand side. We can't really influence the supply side. We're not actually, making microchips that go into vehicles, or finding people on the street and throw them into the labor force. We can't do that, but we can affect demand. Okay. And the important point from this quote, this is from his Jackson Hole speech in August, and he reiterated this after the last FOMC meeting. was, hey, if we don't do what we need to do now, it's going to be a hell of a lot worse. Okay? Now I have pictures that actually, I'm going to try to convince you at that point. But before I do, we're up to about 3.25. The median participant expects us to be up in a range of around 4.25 by the end of the year and go a little bit higher in 2023. Now my boss, Raphael Bostic, is on record as saying, hey, we'll get to somewhere in this range, somewhere that's restrictive or moderately restrictive in the stance of policy, and I'd like to see us hang out at that level for quite some time. And I think, I'm not going to point out which dot is his, but there are a lot of other individuals on that committee that don't necessarily share the same view. Well, I kind of think that what Chair Powell was saying, what my boss has been saying, reflects learning that actually occurred, that has actually occurred from the 70s, from the great inflation period. Okay, and what's that learning? Well, during that period, and this is a picture of, the green line is money growth, M2 growth year over year. The blue line is the unemployment rate. This is what we refer to as the sort of stop-go policies, the stop-go monetary policy. Monetary policy would be restrictive, money supply would decline until we got an increase in the unemployment rate. When the unemployment rate moved, the Fed was keen to respond to that and respond vociferously. And it did it multiple times over this time period. This is sort of stop-go. As soon as things look better on the unemployment side, it's time to remove stimulus. Okay, and it's basically an acknowledgement at the time, and this is up on our website. I have a colleague of mine and I have a piece that goes into this in much more detail on our Atlanta Fed macroblog. But the point here is that monetary policymakers at the time thought that a lot of these relative price changes, a lot of these cost push shocks were what's driving the overall trend in inflation. And it wasn't monetary policy, it wasn't money growth. It wasn't the stance of policy, it was all this other stuff that was outside of our control. Okay, so they keyed on what was happening with the unemployment rate. Okay, and you can see this again, the green line's money growth, the red line is CPI inflation. But I want to point something out to you here. Let's add inflation expectations, and you can kind of draw this increasing sort of trend line here. In monetary policy, the pernicious part of the stop-go policy was that policymakers at the time were never allowed inflation to retrench back down into that 2% or below range. And when inflation's in that range, hell, no one even knows the definition of inflation. No one cares when it's low and stable. And they never gave it time to get back to 2% or to recede back into everyone's memory. And then we got what we got. We got inflation expectations became unanchored. We had this spiral of very, very high inflation. We had mortgage rates that were north of 10%, and I actually think 10%, depending on what time period you're talking about, was actually pretty good at the time. I mean, this is the problem. Okay, and actually this is the problem that I think is on the minds of some policymakers. Get into restricted territory and hang out. How long? Well, our best guess on the maximum impact from an unanticipated change in monetary policy onto inflation is about, God bless you, is about a year to a year and a half. So what we're doing now what the FOMC, what my boss and others are doing right now, hasn't even begun to impact the inflation environment, okay? It's likely to impact the real side of the economy first. So we'll likely see employment growth slow, we'll likely see the unemployment rate come up a little bit, hopefully we'll see wage growth trend in line with where inflation's at, or going. But that's all likely to happen before inflation really gets under control. Okay, before we start to see inflation go back down to 2%. So I'm as excited as anybody in this room about tomorrow's CPI report. I really am. I actually am. But that one's not meaningful in the great sense. Okay, Neither is October's or November's or December. I mean, we're talking next June, okay? So if you have me back here next year, next October, we can have another chat about what's going on. But that's really what I'm trying to describe is that need to be very persistent with where rates head in the future. Yes.
All right. So next year CPI is at like 3.5, but there's some market turmoil where the VIX is at like at 50. Right. There is some systematic problem in markets. What is the Fed response? Do they deal with that risk, or do they stay on the hammer?
Okay.
Stay on the
So
hammer.
still a Fed put, I think is what he's asking.
Well, I mean,
I'm going to completely speculate. Yeah,
Right?
I'm going to completely speculate.
Yeah.
And I'm going to say that we can turn the camera off. These are my views. What happened a couple weeks ago in the UK?
Yeah.
Is there a good enough answer that I think I can say something like that and still weasel out and keep my job? Because I'd like to talk to you guys next year. These have been fun. Good enough?
Great answer.
Fantastic. Anything else that I can punt on? All right, beautiful. Thank you all very much.